Australia, a land of golden beaches, endless skies, and a lifestyle envied by the world. A nation built on diversity, freedom, and dreams. But behind the postcard perfect image, something is shifting. Major news outlets are now whispering a chilling phrase: Australia's quiet collapse. What's really going on? Is this the beginning of a hidden unraveling? In this video, we peel back the layers and reveal the unsettling truth no one dares to talk about. Welcome to Thanh Labs, where we transform dry, complex financial stories into soothing sleep experiences, using sleep psychology and sound therapy to help you drift into deep, effortless rest. Don't forget to subscribe, like, share this video. It really means a lot, keeps me going on this journey. Sleep deep, learn passively, and wake up wealthier. Part 1. The Gilded Surface. A Portrait of Unrivaled Wealth. Chapter 1. The numbers don't lie, or do they? To understand the Australian story, we must first begin with the numbers, because the numbers are, in a word, staggering. For many years, the financial world would eagerly await an annual report. First compiled by the bank Credit Suisse, and now by its successor, UBS. This was not your typical economic report. It didn't just look at GDP per capita measure of how much economic output the average person produces in a year. Instead, it sought to answer a much more personal and profound question. How wealthy are the actual people of the world? The report meticulously calculated the net worth of individuals, country by country. It looked at their assets, their homes, their investments, their savings, subtracted their debts. This gives a far more accurate picture of accumulated prosperity. After all, a high-income software engineer in San Francisco who spends everything on rent and avocado toast may not be building wealth as effectively as a person with a more modest income who is steadily paying off a home and investing for the future. Year after year, when this global wealth report was released, one country consistently stunned observers with its performance: Australia. In the most recent 2024 report, the figures were once again remarkable. Australians had the second highest median net worth on the entire planet. They were surpassed only by Luxembourg, a tiny European micronation that functions more like a private wealth club than a country. A place most of us are not in the tax bracket to even be aware of. Now, the word median here is critically important, and it is the key to understanding the illusion. The median is the person exactly in the middle. If you were to line up every single adult, from the poorest to the richest, it is a much more honest representation of the typical person's experience than the average, which can be easily skewed. Think of it this way: if you have 9 people in a room with a net worth of $50,000 each, and Bill Gates walks in, the average net worth in that room suddenly becomes hundreds of millions of dollars. But the median net worth remains $5,000, a much truer reflection of the financial reality for most people in that room. The UB's report shows that while America has a slightly higher average net worth, Australia's median net worth is more than double that of America's. What this tells us is a tale of two countries. It suggests that in America, wealth is heavily concentrated at the very top, with a small number of ultra-wealthy individuals pulling the average up, while the person in the middle is left far behind. In Australia, on the surface, it suggests that wealth is more evenly distributed, that prosperity is a shared experience. From the outside, this paints a picture of an economic utopia, a place where the ordinary person has managed to build a formidable financial fortress. But as we will soon see, the bricks of that fortress are made from some very unusual and perhaps very unstable materials. Chapter 2: The Engine of Fortune, a system called superannuation. One of the primary engines driving this incredible accumulation of wealth is a uniquely Australian creation called superannuation, or super as it's commonly known. Imagine the American 401 or IRA system, our primary vehicles for retirement savings. Now, imagine if it weren't voluntary. Imagine that, by law, for every single dollar you earn, your employer was required to contribute an additional, significant percentage directly into your personal retirement account. This contribution isn't a benefit to be negotiated. It is a legal mandate. That is the essence of superannuation. Currently, the mandatory contribution rate is 11.5% of an employee's salary, and it is legislated to rise even higher. This means that every Australian worker, from a barista to a banker, is effectively saving more than a tenth of their income for retirement automatically. It is a level of disciplined saving that would make even the most prudent financial planners here in America blush with admiration. The system was designed with a noble goal: to ensure that as Australia's population ages, individuals would have a substantial private nest egg to rely on, reducing the strain on the government-funded public pension. And by all accounts, it has built an astonishing mountain of money. According to analysis by J.P. Morgan, the average Australian household holds the equivalent of nearly $250,000 in this single asset class alone. This is before you even consider their other savings, their non-retirement investments, or the value of their homes. The collective pool of Australian superannuation is now worth more than $2 trillion. It is a river of capital so vast that it has actually outgrown Australia's own domestic investment market. Because this system is mandatory and applies to all workers, it has also helped prevent the extreme concentration of retirement savings in the hands of the already wealthy that we see here in the United States. It is, by many measures, a genuinely amazing financial tool. It has been so successful, in fact, that it has helped to paper over a multitude of sins. It has provided a comforting cushion of wealth, a reassuring number on a statement that has made it easier to ignore the deep structural problems quietly eroding the country's long-term viability. It is a golden blanket, warm and heavy, draped over a foundation that is beginning to crack. Part 2. The cracks in the foundation. If Australians are so wealthy, what is the problem? The problem is that the different pathways to actually obtain and grow that wealth have become dangerously narrow. The nation's prosperity has become intensely dependent on just two things. You might call it a national obsession with dirt. The first way is digging that dirt out of the ground and selling it as raw, unprocessed, natural resources. The second is selling the dirt on which they live back and forth to one another at ever-increasing prices. Chapter 1. The Curse of Simplicity, an Economy of Dirt. There is a fascinating metric known as the Economic Complexity Index. It ranks a country's economy based on two factors: how diverse its exports are, and how unique those products are. A country with high economic complexity, like Japan or Germany, exports a wide variety of sophisticated, specialized products that few other nations can produce, things like advanced robotics, precision medical equipment, and high-performance automobiles. A country with low economic complexity exports only a few basic commodities that many other countries can also provide, like oil, timber, or iron, or a complex economy is a resilient economy. It has many different engines of growth. So if one sector falters, others can pick up the slack. A simple economy is a fragile one. Its entire fate is tied to the fluctuating prices of a handful of commodities. Australia has the lowest economic complexity of any developed high-income country in the world. Let that sink in for a moment. Out of 146 countries ranked in the survey, Australia sits at 102nd. This is not a recent development. Its ranking has been falling consistently since the 1950s, when it had a respectable manufacturing base and a burgeoning research sector. Today, its economic complexity puts it behind countries like Uganda. The nation has become almost entirely dependent on selling natural resources and livestock to the growing economies of Asia. This has created a powerful, self-reinforcing cycle. When investors in Australia look for opportunities, they face a choice. They can fund a risky, innovative, new startup that might change the world and perhaps provide a sustainable return. Or they can invest in developing another iron ore mine to sell more resources to an existing. For decades, the second option has been the far safer, more predictable bet. The result is a tragic irony. Australia possesses some of the most advanced natural resource extraction technology in the world. Yet, it is severely behind in other critical areas of innovation, like technology and advanced manufacturing. The Australian government itself has helped fund groundbreaking scientific research. The fundamental technology behind Wi-Fi, modern solar panels, essential medical tools, and even the platform that became Google Maps all had their origins in Australian research labs. Any one of these inventions could have become a cornerstone of the nation's economy, a major contributor to the prosperity of its relatively small population. But when the time came to commercialize these world-changing technologies, to build businesses around them, the country lost out. The investment capital simply wasn't there. It was all flowing into the mines. And so, these brilliant ideas naturally migrated to places where they could find funding from investors willing to take a risk. Places like Silicon Valley. For a long time, this narrow focus created another vulnerability. The value of the Australian dollar became almost perfectly correlated with the price of natural resources. When commodity prices were high, the currency was strong. When they fell, the currency weakened. This meant that every Australian investor, whether they liked it or not, was effectively a resource investor. Their fortunes rose and fell with the red dust of the outback. This connection has weakened since the global pandemic, but this is not the good sign it might appear to be. It could be the most significant indicator yet that Australia has dug itself into a hole, literally and figuratively, from which it will be almost impossible to escape without sacrificing a great deal of the paper wealth it has become so accustomed to. Chapter 2: The National Pastime. A gamble on prosperity if the first pillar of the Australian economy is mining. The second, and perhaps more insidious, is gambling. Here in America, we've witnessed the explosive growth of sports betting and online casinos since regulations were loosened in 2018. Billions of dollars have been spent by companies like DraftKings and FanDuel in a frantic rush to acquire customers, often running their operations at a loss just to grow their market share as quickly as possible. Why are venture capitalists willing to burn billions in such a risky industry? The answer, in large part, is because they have looked to Australia. Australia is living in the future when it comes to gambling, and that future is a bleak one. According to the Australian government's own inquiries, Australians lose almost $1,000 per person every single year through various forms of betting. And that figure includes the large portion of the population that doesn't gamble at all. For the average person who does participate, the losses are statistically far, far worse. The gaming industry in Australia is not on the fringes of society. It is deeply, fundamentally woven into the fabric of daily life. The average neighborhood pub or social club operates like a miniature casino. They are filled with the hypnotic lights and electronic chimes of around 200,000 electronic poker machines, okay, known colloquially as pokies. Losses on these machines are capped, but at a staggering $100 a day and $5,000 a year per person. Betting on sports is commonplace. Horse racing is a national tradition so significant that it has its own public holiday. This is all on top of the more conventional forms of gambling like state lotteries, large casinos, and scratch-off tickets. American investors have done the math. They see a country where gambling is normalized and immensely profitable, and they dream of replicating that model in a market as large as ours. Australia also serves as a business case against the risk of regulation. The sheer pervasiveness of gambling in Australia has, unsurprisingly, caused devastating social problems. The country is grappling with an epidemic of addiction, fraud, petty crime, and domestic violence, all stemming from unhealthy gambling habits, particularly among young men. The public largely dislikes how omnipresent gambling advertisements and venues have become. You would think, then, that it would be easy to gather the political support to pass laws to moderate the industry's reach. But you would be wrong. The gambling industry employs many people. It spends enormous sums of money on lobbying and on public relations campaigns, fear-mongering about the job losses that would occur if a local bar could unhave a casino floor stapled onto its side. And so, the government has been extremely soft on regulation. But it is a powerful symbol of the deeper issue. There are genuine, serious problems festering just beneath the surface. But nobody in a position of power wants to be the one responsible for shaking up the delicate balance of prosperity. However illusory it may be, the same dynamic that protects the gambling industry also protects the mining industry. And as we shall now see, it protects the most leveraged and dangerous part of the economy of all. Part 3. The elephant in the room. The great Australian dream. Every issue we have discussed so far is magnified and made infinitely more complex by the single biggest factor in the Australian economy: the cost of housing. The real estate market has made every other problem worse, and it is the primary reason why fixing those problems has become nearly impossible. Chapter 1. A nation of landlords and debtors in America. We are all too familiar with the struggles of an expensive housing market. But the situation in Australia makes even our most overpriced cities look almost reasonable by comparison. According to a broad market survey, the average age of a first-time home buyer in Australia is 36 years old. Think about that. Most people are well into their professional careers, perhaps already starting families, before they can even take the first step onto the property ladder. And the fastest growing group of people buying a home for the very first time are those aged between 40 and 49. Homes are so expensive that they are typically financed with 30-year mortgages. And because families often move into larger, more expensive homes as they build a little bit of equity, a significant portion of the Australian population is now reaching the age where they would normally be thinking about retirement, still carrying a mountain of mortgage debt. This reality has fundamentally warped the purpose of that amazing superannuation system we discussed earlier. A common and financially sensible strategy for many Australian workers is to wait until they reach preservation age, when they can finally access their retirement savings. They then take the entire lump sum that they have accumulated over their entire working career and use it for one single purpose: to pay off their remaining mortgage. Technically, this transaction doesn't make them any poorer. They have simply transferred their wealth from a retirement account into real estate equity. But it reveals a profound truth about the Australian economy. One of the nation's greatest wealth-building tools, a system designed to provide a comfortable retirement, has become little more than a final, desperate measure to prop up a housing market so expensive that the rest of the world should be afraid of it. Chapter 2: The Special Ingredients of a Bubble. How did it get this bad? The familiar ingredients are all there: years of low interest rates, investor speculation, local zoning restrictions that prevent new construction, and high levels of immigration into major cities that simply couldn't expand fast enough to accommodate everyone. But on top of this familiar recipe, Australia has added its own unique and powerful special ingredients. The first is the tax system. Taxes on earned income in Australia are among the highest in the developed world. Someone earning the equivalent of just $120,000 American dollars a year would find themselves in a 45% tax bracket for every additional dollar they earned. And remember, Australia is not a cheap place to live. While that is a very good salary, it does not go nearly as far after nearly half of it is taken by the tax office. However, the tax system has a peculiar feature. Personal investment losses, including paper losses from real estate, like depreciation, can be used to write off your personal income, reducing your overall tax bill. This system, known as negative gearing, effectively turns every high-income individual into their own small business, able to accrue expenses to offset their taxable income. And what is the best business to get into if you want to generate large, predictable paper losses? Real estate. This tax structure has created a massive incentive for high-income earners to buy investment properties, not necessarily to make a profit from the rent, but to generate paper losses that they can use to turn their highly taxed earned income into much more favorably taxed capital gains when they eventually sell the property. Almost every economist in Australia agrees that this system is broken. It inflates a housing bubble, locks out first-time buyers, and misallocates capital. It would be far more efficient to simply lower the income tax rate for everyone and get rid of these write-offs. But it has been politically impossible to change because the government cannot afford for this house of cards to unravel. The second special ingredient is the nature of its immigration. Australia has experienced some of the most intense immigration rates in the world. The country has become highly dependent on this flow of new people, not just to do the jobs that many locals are no longer willing to do, but also to provide a constant stream of new buyers for its overheated asset markets. According to one law firm that specializes in arrangements for wealthy immigrants, over 40% of the millionaires living in Australia today were not born there. Some, of course, have gone there and made their fortunes, but most have simply gone there to park the fortunes they already made elsewhere, safely storing their wealth in the perceived stability of Sydney and Melbourne real estate, pushing prices ever higher. There is now so much wealth and debt tied up in Australian housing that the entire economy could be devastated by the mere suggestion that the government might rein in these incentives. Part 4. A system on borrowed time. When you step back and look at the entire picture, you see a system of deeply interconnected, codependent parts, each one propping up the others in a delicate, dangerous balance. The mandatory superannuation system creates a vast river of savings. But because the domestic economy is not innovative or diverse enough to absorb it, much of this money has to be invested abroad. A majority of it ends up right back here in the American stock market, fueling the growth of our companies. In a way, Australia is taking the cash it earns from its mining industry and giving it to us so that we can build the businesses of the future. The wealth of the average Australian is now heavily reliant on the performance of the magnificent 7 tech stocks. Meanwhile, back home, the wealth that is invested locally is channeled into a few narrow sectors. The country's largest and most valuable banking institutions have their fortunes almost entirely tied up in lending to an overvalued real estate market. Workers are taxed heavily on their income while their real wages decline, and they watch the dream of home ownerships slip further away. Businesses outside of mining, gambling, and real estate find it increasingly expensive and difficult to operate. And all the paper wealth in the world, the impressive numbers in a UBS report, does end to mean very much if it can only afford you a 1-bedroom apartment, a 2-hour commute from anywhere you might want to be. This is the Australian paradox. It is a country that has, so far, managed to keep everything on track. But there is a profound difference between success and merely delaying the consequences. Australia serves as a crystal ball, a look at what 10 years from now could mean for us here in America if our own trends continue unchecked. A future where housing is treated not as shelter but as a financial asset, where unproductive and harmful industries become too big to regulate and where the real economy of making and innovating is sidelined in favor of the easier path of speculation. From the sun-drenched beaches and bustling cities, we have journeyed deep into the economic heart of Australia. We have found a nation that is, by one measure, among the wealthiest on earth, yet, by another, is living on borrowed time. Its story is a powerful reminder that the numbers on a page do not always tell the whole story. The true wealth of a nation cannot be measured solely by its median net worth or the size of its retirement funds. It is also measured by its resilience, its diversity, its capacity for innovation, and the quality of life it offers its citizens. Australia has become wealthy by getting lucky in a few key areas, and then by going all in on keeping those areas alive by any means necessary, even at the cost of its own long-term economic health. It is a cautionary tale about the allure of easy money and the danger of building a palace on a foundation of sand. The story is not over. The country has proven to be remarkably resilient in the past, but the challenges it faces are immense. It is a quiet drama playing out on a continental scale, a test of whether a nation can gracefully pivot away from a model that has made it rich, but also vulnerable before the consequences of its choices can no longer be delayed. Thank you for listening. I hope tonight's story from Thanh Labs has offered you some quiet reflection and a measure of peace. Don't forget to like, share, and subscribe to support our channel. I wish you a very deep and restful sleep. I will see you again in our next story.